Hello everyone, and welcome to the final of the 3 videos on the civil courts, and this one is on damages. And just remember what we've been talking about over the last sort of 6 or 7 videos in terms of negligence, and that we're using the term damages with the S in this instance, and by that we mean remedies. What do we give people who have been able to prove that they have their duty of care has been breached? Of course, the alternative is to think about damage, and that's the issue of causation and remoteness together, and it's the third part of our tortious equation. This video is about damages, what we get if we win in court, essentially. And I'm going to start with the central premise of tort, and that is damages should restore the claimant to the position they were in before the accident, before the accident or loss as far as money can. What we mean is that after all of the dust has settled and everything is finished, as far as money can do it, the claimant should be back in the position they were before the accident happened. And the sort of purpose of the purpose of damages and the purpose of tort is that it is compensatory. Damages in negligence cases are compensatory. The claimant will have losses repaid, so losses are going to be repaid. And that's pretty much what this video is about. And they might get some further money to compensate for future losses. And we'll explain what we mean by that as we go through the video. The law is not concerned with punishing the defendant, only compensating the claimant. So it's not concerned with punishing the defendant, but with compensating the claimant. Because the claimant is not expected to profit. Remember, it's about returning them to where they were before the accident happened. So there's not expected to be any concept of profit. And the claimant must follow the principle of mitigation. And that means minimising loss by taking reasonable steps to do so. So that means minimising loss. And an easy way to explain that, really, an accident might be replacing a car that is damaged in an accident immediately, not after claiming weeks or months of car hire. To mitigate the loss would be to replace your car straight away. And that way your final claim might be a lot less than what it would be if you said, I'm not going to replace my car for 6 months and I'm just going to hire a car. So I could just do that with a monetary example, which is something that I did with my students this week actually. If you imagine that the cost of my car to replace it is £1,000. If I replace it now, straight away after the accident, the cost is going to be £1,000. The amount that we are going to claim from the defendant will be £1,000. So let's call that now. If I was to wait 6 months, I would have the £1,000 for the cost of the car, plus perhaps, let's call it £100 a month, £600 to hire a car for 6 months. That gives a total that I would need to claim for £1,600. Now that extra £600 is not fair just because I've waited for 6 months before I've gone out and replaced my car. To do it as soon as possible is known as mitigation. And insurance companies operate the principle of mitigation of loss quite frequently. Now in reality, the claimant only has to make sure his actions are reasonable. He doesn't have to go to ridiculous lengths to make sure that he mitigates every single loss. Now in terms of damages, it's only possible to receive damages once, even if there are multiple causes. I don't know what was going wrong when I produced this back slide, but another spelling mistake. The claimant can only receive damages, oh no, there's another one, can only receive damages once, even if there are multiple causes. And you might remember the case that showed us that was Barker versus Chorus, 2006. And that was a multiple causes case concerning asbestos. And the idea was that you can claim many times, you can sue many different employers for a loss that you've had, but you're only able to sue them once. And the amount might possibly be reduced where C has contributed to the loss. So if the claimant has contributed, then the amount might be reduced. We're going to deal with contributory negligence when we look at A-level, A2 level tort. But as an example, if I have a car crash and I'm not wearing a seatbelt, and my injury is worse because I am not wearing a seatbelt, but the accident remains the fault of somebody else, I have contributed to the level of harm that I have endured, and therefore a reduction will be made for my contributory negligence. Now, where personal injury, or where the loss is a personal injury, there is a preliminary notion given to the amount that one is likely to receive, and that's known as a quantum. And this helps, a quantum helps negotiation. It allows people to sort of see what the eventual cost, if you go through court, might be. And that helps negotiation and helps keep cases out of court. And what we ought to do now, I suppose, really, is to see how quantum of damage works. And there are 4 key boxes. Quantum of damages is split into 2 types: special damages and general damages. Special are the losses that are particular to the claimant in the event that has occurred. So these are losses that are current. And by current we mean up to court date. Examples of that might be medical treatment, for instance. We'll look at these in greater depth in a moment. General damages are those that are presumed to follow. So they are future issues. So what you are likely to occur after the court case. So an example of that might be loss of earnings. And you also need to distinguish between both pecuniary and non-pecuniary. Pecuniary losses are those that incur a financial loss. So they will be financial loss. Non-pecuniary are those things that do not have a ready financial value, but for which somebody is still compensated. So that might be pain, for instance. So you are going to have the likelihood of a pecuniary loss in special damage and a non-pecuniary loss in special damage, also a pecuniary loss in general damage and a non-pecuniary loss in general damage. Sorry, we'll put pain again. So, how much am I going to be paid for medical treatment for the loss of my car and for the amount of pain I've suffered up to the court date? Okay, and then how much money might I need to take care of me in terms of my illness? So let's say I might need a wheelchair going forward. I might need to, in the long term, look at developing my house with ramps and so on and so forth. And then how much pain am I going to be suffering on into the next 10, 15 years as a result of the accident? So let's have a look at each of these in turn. Let's look at special damages and then let's look at general damages. And special damages are financial losses, as we've just said, up to the date of the trial. And it must follow from the negligent event and the losses that are particular to the claimant. So the special damages must be related to the accident or the event. And these things can all be given an exact figure. And the exact figure, for instance, might include medical expenses. We've already discussed that. Prescription charges in this case. Hospital fees, for instance. Hospital charges. There might be a case that if you were picked up by a private ambulance fees. And it can also include loss of earnings up to the date of the trial. Remember, this is all up to the date of the trial. Now that is straightforward where the claimant is employed. There will be a deduction, of course, from any benefits like statutory sick pay that the claimant has received. So, for instance, let's say the claimant's wage is £1,000 per week. Lucky old fella. He loses that £1,000 a week as a result of the accident, but the state pays him £100 a week in sick pay. These aren't the right figures, by the way, I'm just making these up. The claim for loss of earnings would, of course, be £900 a week because the state is going to pay a benefit. But the difficulty comes when the claimant is self-employed. Because, or of course, it might not only be self-employed, they might work overtime lots, they might have irregular hours. It becomes harder to calculate. And the reason for that is, let's say, for instance, a landscape gardener. A landscape gardener might very be very bad weather and have no work this week, but then be absolutely swamped with work the week after. So exactly calculating what they might earn is difficult. And the way that that's done is by taking an average from the previous 26 weeks. So for self-employed, we're going to take an average for the previous 26 weeks. Now, damages to goods are easy to calculate. So, for instance, look at the state of that car. I can take that car to the garage and the garage will give me a bill. They'll tell me how much it is to put that right. So that's easy to calculate. And it's worthy of saying that that calculation is the market value before the accident. Okay, remember, this is all about putting the defendant back to the position they were before the accident. So we're going to look at what's the market value of the car, in this case, before the accident. So that's special damage, everything up to the date of the trial. The next thing to look at is general damages. And general damages covers anything that does not have a readily quantifiable figure. And you might say, well, earnings are quantifiable, but the difficulty is, what are you going to be earning in a year's time or 2 years' time? It's not easily quantifiable. I know what I'm earning now, but I might not know what I'm earning in 5 years' time. So general damages become more difficult to quantify. And they also cover pain, suffering, and loss of amenity. They cover future medical costs. Okay? And then they also cover loss of future earnings. Now, obviously, picture a Lance Armstrong. I've only used that to demonstrate that Lance Armstrong's future earnings have been hugely reduced. That's got nothing to do with the tort of negligence, it's just there as an example. So general damages cover things like pain, suffering, loss of amenity, future medical costs, and loss of future earnings. So let's look at pain, suffering, and loss of amenity. It's difficult to calculate. We've got to look at physical and mental suffering. That's got to be included. And the injury itself, and the injury, in this case to this poor woman's neck. You've got to look at the reduction in quality of life, and that is what we know as loss of amenity. So loss of amenity is a reduction in the quality of life. And the easiest way to calculate this, because it is difficult to calculate, is by something known as the Judicial Studies Board. And that allows a general consistency. It provides a range to operate within, and it aids out of court settlements. And the Judicial Studies Board essentially gives you some numbers. So, for instance, a broken nose is about £1,000. a simple fracture of the forearm is around about £3,650. Now remember, with all of these, you can get them on www.thelawbank.co.uk, and you can download the PowerPoint that will have a much broader range of numbers from the Judicial Studies Board. There are many factors that are taken into account when making a calculation and looking at the Judicial Studies Board, and one of those things is just what is the size of the impact on everyday life activities. That might be not being able to play golf, not being able to shave, not being able to do housework. So the range that the Judicial Studies Board will give for a particular injury will need to be almost like a needle on an accelerator. The more loss of immunity you have, the closer you'll be to the top end of the scale in terms of the loss. Future medical care and personal assistance covers all the future care. It can also include the loss of wages of a relative. So it might include the loss of wages of a relative. And by that I mean somebody who might give up their job to look after you. So a husband has a long-term, almost lifelong injury, and his wife decides to give up work to look after him. She can claim for her loss of injuries. And even in minor cases, an award of damages can be made for care. An example of that is Giamborne versus GMC Holidays in 2002. In that case, the children got food poisoning on a holiday. Parents had to care for the children throughout their holiday and therefore lost their holiday. They were allowed to claim for their holiday because of the care that they had to give to their children whilst they were sick. Now, in terms of loss of future earnings, there is a basic formula based on the amount of reduction in annual net. I'll put the calculation up. The basic formula is based on the amount of the reduction in net annual earnings. So how much has the claimant's net annual loss been? And that's known as known as the multiplicand. There may be some deductions for benefits, depending on what those benefits are, in part of the calculation. And that's calculated by the number of earning years that are left. So let's look at the calculation again. What is our net annual loss? So let's make the numbers easy, that I earn £10,000 per year. I'm not getting any benefits because of it, I've just lost £10,000 per year. Now let's say I've got 10 years left of work. If we times £10,000 per year times 10 years left, that roughly gives me £100,000 as a settlement. Now, some of that will be reduced because if I get my lifetime earnings in one sum, I'm going to be better off. I'm going to be able to put that in the bank. I will be able to add interest. And if I add interest, it means that I'm going to be better off than I was before the accident. So there will be a reduction, a deduction, because I'm getting it in one lump sum. The difficulty with this approach is that the calculations are not accurate. And some claimants benefit, so some claimants benefit and some lose. And I'll give you an example. Imagine the claimant both of these claimants get £100,000 each. The claimant that might lose on that, believe it or not, is the claimant that might live another 25 years. If the claimant that only lives 5 years after the accident, essentially they've profited because we've calculated their sum on 10 years. Now that might seem harsh, but rather than get £10,000 a year, they'll be getting £20,000 a year for those 5 years. I think what I'm trying to say is death expectancy, life expectancy, means that some claimants benefit and some claimants will lose just in terms of the money that they get. And the courts do not take into account loss of life expectancy. Nor do they take into account the expected rate of return from investments. So if we were to invest this money, the courts don't take into account the amount of money that you're going to make in terms of interest. Now finally, let's just whiz right to the top and look at the methods of payment. Traditionally, these payments have all been paid as a lump sum. But as we've said below, lump sums can be invested and the claimant can gain. And if we look, it's convenient that here we've got our formula that we should restore the position that they were in before the accident. If you can invest a lump sum and gain, you're going to be better off than before the accident. And we know, therefore, that there's a reduction made for that lump sum payment. Now, lump sums are good for damage. So if I've got to replace my shed or replace my car, they're good for that. But periodical payments are much better for income. And these are called a structured settlement. And structured settlements are dealt with in the Damages Act of 1996. Structured settlements are normally paid by the defendant's insurers. Once a lump sum amount is agreed, some will be paid in terms of a lump to take care of the things that you need to pay for, a new car, perhaps building ramps in your home, so on and so forth. And some will take the form of a periodic payment. And these will be structured to meet the claimant's needs. Now, there can be tax advantages for this, for the claimant, but also it solves the problem for the insurer of the amount of time that the claimant lives after settlement. So if the claimant was to have 50% given here of their money, so that means that 50% of the money is going to be paid over the next 10 years. If the claimant dies after 1 year, the insurance company has saved 9 years' payment. Now that again might seem harsh, but remember, if the claimant was to die, the other 40, whatever that is, the 9 years payment, I can't do the maths, the other however many, 80%, the other 80% of the lump sum payment that was going to be structured would mean that it would go to the estate. And although the claimant might not necessarily benefit or profit, the claimant's estate would profit by that money if it had been paid out all as a lump sum. So structured periodical payments assist in terms of keeping insurance costs down and help the insurance company to spread the cost of damage payment. So that's it. Damages are relatively straightforward. They're relatively simple to answer in exam questions. And what will generally tend to happen is the scenario that you will have answered a question on will ask you something about the route to court or which court it might be heard in. And then it will say, what are the sort of damages that X can be considered likely to be able to claim? And it will expect you then to talk about what are the special damages and what are the general damages. And the scenario will give you enough information to be able to talk about that.